Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. My two co-hosts, Mark Humph and Nam Fawn, are off today, but I do have a special guest I'm going to introduce in just a second here. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. And that certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is miscellaneous trivia. And today in the studio, we have Bill Bymel, CEO of First Lien Capital LP, a distressed mortgage investment platform. Bill, welcome to The Best of Investing.
Thank you. Glad to be here.
All right. So let's get right into it. What is going on in the real estate and mortgage market these days that perhaps the public is not seeing or reading about?
Well, the thing that everybody in the public is hearing about is a dramatic rise in interest rates the last 6 months. And here we sit, October of 2022, a year ago today, a $300,000 mortgage, you could probably get a conforming loan, in the 3.5% range. It would cost you $1,400 a month. And here we are 1 year later, rates are more than double that in many parts of the country. So that same $300,000 mortgage costs well over $2,000 a month. And what we're not seeing is how much a prolific effect this has had on the mortgage origination market, real estate volumes in general. Real estate tends to be a little bit of a lagging industry in terms of reporting. So a lot of the slowdown that might be happening, we're not yet seeing in the public eye. Where I'm seeing it is I play in the secondary mortgage market. I deal with the private equity, institutional investors, banks that are financing the origination of these mortgages, single family or otherwise, all around the country. And what I see right now is a bloodbath in the world of mortgage originators that have been trying to they're in the refinance business. Every day, the big originators, Rocket Mortgage, announces new layoffs. There are smaller non-bank lenders that are highly leveraged, and right now, because of the major move in interest rates, are now seeing their capital lines either pulled or paused, or the rates on those wholesale lines have also gone up. So they've gone up very quickly, while it's been hard for lenders and originators to bring new product into their portfolio at those higher rates. You see a lot of non-bank lenders in a negative leverage situation right now.
Well, let me ask you this, because it seems like, let's say, just pick Rocket Mortgage just because you mentioned them. And nothing bad about them, just the idea of what's going on. So 2 things I see, and tell me if I'm correct in this. Two big problems I see for them is, and regular banks like that, is the fact that a lot of buyers are easing up on their purchases, canceling contracts, etc.
Right.
But then also, because interest rates have gone up, the refi market is, I don't want to say zero, but there's not much to read. If you were smart enough to refinance at 3% a few years ago, why are you going to refinance again at 7%?
Exactly.
Yeah.
Exactly.
That's why all these layoffs.
Market is. That some companies that are out there that rely majority on refis, and Rocket's pretty heavy on the refi market now. Yeah. They're trying to do stuff, lowering their guidelines, trying to do stuff to maintain origination flow, but they need to be proactive. Companies like these companies need to be proactive in terms of restructuring their model and their expectations and their overhead moving forward, because you're absolutely right. You've got some companies out there that have already completely gone under. There's a company called Sprout Mortgage You know, when they went out of business about two months ago, the day before payroll, left, several hundred employees in Southern California without a payment. Now there obviously are lawsuits and people will get paid, but you've got one of the largest aggregators of conforming and non-conforming originations, guaranteed, what's it called? First Guarantee Mortgage Corporation. They went into bankruptcy 3 months ago.
Is that right? Wow.
Yeah. I mean, there is a lot of stuff that is happening that's making the headlines amongst us in the mortgage and real estate industry, but has not yet really hit the public eye.
Well, something like a Rocket Mortgage, you got to figure that they've got to have leverage too. And that, like you're saying, with regard to their lines of credit or their investors demanding a higher rate of return. I don't know exactly how they're financed, but that could really squeeze the market.
That's exactly what I anticipate is happening and will continue to happen through the end of this year and possibly into the first or second quarter of next year. I mean, we are not yet, since this is a public radio station, I'm not going to use curse words, but we're not in the we're not there yet. Believe it or not, with all the bad news you're seeing in the stock market, with all of the start of the hints of certain parts of the country, real estate, deal flow is slowing down and commercial deals are dying. We are not yet at the worst of it.
All right, we're going to continue in just a minute. Our first trivia question: what common anatomical part are sharks missing? What common anatomical part are sharks missing? All right, stay with us. Best of Investing. I'll be right back. Welcome back to the Best of Investing. Edward Brown here along with Bill Bymel. First trivia question: what common anatomical part, hey, I finally got that right without mumping up the words, are sharks missing? What anatomical part do sharks not have? What do you think, Bill?
Nose?
Bones. Right, because they have cartilage, not bones. Okay.
My dogs like that answer.
That's okay. Question for you, because it's interesting. I do a lot of work with Pacific Private Money, and they're very busy right now. And I have to think that even though we were just talking about the problems in the mortgage market, the fact is, because of a lot of companies, let's say like a Rocket Mortgage, have laid off people, it seems like Pacific Private Money has become a bigger fish in a smaller pond.
That's exactly right. And you'll see more of that happening as the more conforming, traditional, bigger lenders, or even private lenders, some of the smaller ones, as they continue to evaporate and just go, some are just not lending whatsoever. And you'll see the private money lenders definitely increase market share. You're going to see I think a lot of the refinances you will see in the coming year are going to be bailout refinances or people that are trying to get around, the fact that they, are in some kind of a situation, whether it's a maturity default or whatnot, then they have to finance. And they're some of them will have to seek private lending organizations.
Yeah, because hopefully the banks won't go back to 2007 and 8 where they were just lending out money like water. I mean, they have, Dodd-Frank has put some restrictions on that, and hopefully they won't just loosen that up too much.
Well, it's interesting that you say that, Edward, because that is true. The banks do have much high, like if you're getting a loan from a bank, you are definitely a top credit quality borrower. The issue is that the mortgage industry, when you look at residential mortgages, for instance, traditionally about 70% of mortgages in this country were financed or originated by banks. Yeah. Even if you start to include the government owned or the government insured loans, that industry changed so much since the last downturn of 2008 because of the restrictions that banks had. They then had less opportunity to take market share. And so the bank's market share in this industry, in the $12 trillion mortgage industry, has decreased to about 50% of the mortgages out there. And to fill that 20-30% gap are these non-bank lenders that I talk about. And you don't know, they're not as heavily regulated. So
exactly, they are regulated, but not as much. And they don't have interest reserves and that sort of thing. But it's interesting because you think people still move. People still, the baby boom, well, not the baby boomers, but now the millennials are now starting to buy houses. So it's not like the entire real estate market dried up.
Right.
And so again,
and you'll see that's right. And it's interesting because there's a real opportunity in the fixed income market because of the move in interest rates, and we're looking at this right now. And one of the things I say to my partners is just that, is that even when you have a 3.5% mortgage, a 30-year fixed, there's a certain subset of those people that have to move to a different property, they get a job relocation. There's they get married and have to move up in scale. So those loans do get paid off, and there still has to be some level of activity, obviously, in the market.
Or the baby boomers getting older, like me, who eventually want to go from a 2-story house to a 1-story house, or move closer to their kids, grandkids, stuff like that. So, it's funny. Mark Hahn, president of Pacific Private Money, he always says, you can always make money in the real estate market, not up market or down market. It's just a matter of, where you are. It's just being smart. So let's get into what you do then, because obviously you're not just sitting around going, uh-oh. I mean, you're obviously looking for opportunities.
Oh my gosh, this is the time for me. Because of this discontinuity in the secondary mortgage market, that's really the market that we play in. Okay. So a lot of the product that we source comes from buying from banks, non-bank lenders, institutional investors. And because a lot of those, we're seeing more and more of those guys under stress these days, the opportunities are just unbelievable for a guy like myself right now.
Okay, are they offering to you both performing and non-performing loans?
Correct.
Okay.
Correct.
So and why would they? I can understand why they want to unload their non-performing loans. Why do they want to unload their performing loans?
Exactly what I said in the early part. You have the banks that are leveraging these portfolios are telling them they've got to decrease the LTV because there's an expectation in lowering in values, there's an increase in interest rates. Because of all that, the banks are shutting down these warehouse lines or telling their clients, their borrowers, meaning when I say borrowers, I'm talking about the originators themselves, using wholesale lines of credit, using bank lines. They are forced to sell. And then you've also got other banks out there. I mean, I saw a bank that owned a $30 million set of low interest performing loans. They were conforming. They just never put them into Fannie. So they ended up keeping the loans. And now that interest rates have gone up, there's a directive from the bank to sell those loans at any cost.
I tell you, that reminds me, years ago after my dad passed, my mom, who had a low interest rate loan, it was Great Western Bank back then, I remember. And they sent her a letter saying, if you pay off this loan early, we'll actually give you a discount off the principal. And when I looked at the numbers, it didn't make sense, but I thought it was very interesting that they just didn't want those long-term, low interest rate loans. It's funny. I'm waiting if Loan Depot is going to give me one, because I didn't know I was going to hit it close to the bottom, but I got and I did get a 15-year rather than a 30-year because I wanted to get that extra better interest rate. Sure. But I locked in 15-year fully amortized 1.99%.
Oh, that's amazing. Yeah, so that's a great loan.
Yeah, so I'm waiting for them to say, hey, if you can refinance us out, we'll give you bonus.
It could happen. You're certainly more likely to see it from a Loan Depot if they're sitting on the loan than you would from like maybe a Citibank or somebody that's more of a long-term regulated player.
And whether or not they're portfolio lender or just service on that. Very interesting.
Right. Absolutely. It's interesting times ahead. We're not going to see a mortgage meltdown like we saw in 2008.
No, because it's not a credit bubble.
Correct.
Yeah. So
Correct.
and we'll talk about what you anticipate the prices to drop a bit. Let's go to our second commercial trivia question here. What gymnastic event often sees men performing the Iron Cross or crucifix, they call it? All right. That's our trivia question. Excuse me. Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate, which is worth, by the way, over $100. So it's a nice little gift for you there. Again, here's the trivia question. What gymnastic event often sees men performing the Iron Cross or crucifix? Stay with us. You're listening to The Best of Investing with Edward Brown, our special guest, Bill Bymel. Don't touch that dial. We got some good stuff to talk about. Welcome back to The Best of Investing. One more time, I'm Edward Brown, your host, along with Bill Bymel. Our second trivia question, what gymnastic event often sees men performing the Iron Cross or crucifix? What do you call that, Bill?
It's that thing with the bar where the circles hang.
Yes. What do they call that? The rings.
Rings.
There you go. That's what, I tell you, when I ask these questions, I'm hoping people are listening in their car and they're going, oh, I know the answer, but I don't want to channel surf because I might miss it. So they have to listen to our commercials. Okay. All right. So Bill, let me ask you, what do you expect to happen in the real estate market? Obviously, there's going to be pockets. California is going to be different than Iowa, but generally speaking, what's your prediction?
So, when as prices have increased, you've seen a lot of people who lost affordability in major metropolitans going to greener and growing areas, right?
Yeah.
And now, those are the markets that have seen such dramatic increases in values. Areas like, and then when I say green and grower, I'm talking about old cities, old towns that maybe didn't have popularity before. Boise, Idaho. The Californians fell in love with Boise, Idaho.
San Antonio.
San Antonio, Salt Lake City, Utah.
Yeah.
And these areas have seen, Austin, Texas. These areas have seen, double-digit year-over-year increases in prices. Now you're coming up against a doubling of financing costs, and you're going to see a real reversal. And it's a shame because when the mortgage and real estate market finally starts to become front center page in the next few months, it's going to be things like 20% drop in housing in Austin, Texas.
Okay.
The story behind it is last year prices went up 35%.
Sure.
So,
there's 3% off of today, but
you're going to get some people that were caught with their hand in the cookie jar that didn't, that might have overpaid. And you still see that in markets. You see Southern California, Newport Beach, high quality, new construction, $5 million home. You might get it. You might end up selling that for $6 million, so there's still good quality markets that will demand buyers. But in general, there's going to be pockets of this country, and I think it's going to be the stuff that rose very quickly, that may be the more suburban locations or the areas that people could escape to, because their jobs allowed it. Maybe they're getting called back to work. Along the East Coast, I think Florida will have to see, Florida it's always whipsawed. In Florida, it's gone through, over the years, it's always gone through ups and downs. And yes, you see generally more people moving to Florida. You see a lot of money moving out of the high tax states down to Florida, but it's not going to make up for the rise in interest rates and just the fact that markets are cyclical.
Now, do you think since we're a California-based show, you're in California, I'm in California.
Yep.
We lost the Senate seat. People are saying, "Oh, there's an exodus of California." People, everybody's moving out. I haven't moved out yet, and I've noticed that traffic today was pretty bad still. What do you see from a California market? Again, obviously Newport Beach.
Well, if you've been around, you were around for the last downturn, right? Inland Empire, was so young and green at the time, and it was so speculative that market blew up and became valueless. So I'm not saying that Inland Empire is going to do that, but there's other markets on the exterior of the LA market, for instance, that could see that kind of more serious devaluation.
25%, 50%? What do you think?
Yeah, no, it's not going to. It's not. I would not say 50. I would say at worst case scenario 25.
Okay.
It's hard to predict. I don't think that in general Los Angeles, it's not going to look as bad as it looks. You'll have some very high end of the market that will just have the socks knocked out of it. You'll have I think some commercial. You'll have some distress in the commercial market in LA and Southern California because there's going to be a contraction of businesses, especially in the office markets, a contraction of demand in offices, a need to reposition that in the commercial world. There is still, I think, if you're an affordable housing creator or somewhere in the middle of just above affordable, you might still have, you might be okay. The problem is I talk to a lot of multifamily developers and they all want to sing to that there's going to be so much continued demand because we do have a shortage of housing in America. The problem is we have a shortage of affordable housing, and most developers don't afford to do affordable.
Well, and I guess Gascon hasn't driven everybody out. The interesting thing too about everyone's been hearing about the border crisis and how every town now is a border town. I mean, what is the statistic, if I'm not mistaken, is what 6 million people they're expected, and it's been 3 million so far or whatever. And if you think about it, and not every illegal immigrant coming over is a drug dealer. I mean, some of them have skills, some of them don't, but they all need a place to live.
It could certainly help feed more demand going forward.
Yeah.
And so I mean, look, you're going to see long term. You're going to have markets like Los Angeles, the areas of Los Angeles. Los Angeles is, like every major city, like San Francisco, like New York, going through its ups and downs, crime's an issue, things like that. But people still want to live here. You still, and
weather.
Exactly.
I mean, that's, I feel for the people who went through the Hurricane Ian. And we haven't had an earthquake for a while, but anyway, hey, tell you what, we want to go to our next commercial break. Before we do, I want to make a mention here for Palio Restaurant in San Francisco, been voted one of the best restaurants in San Francisco by San Franciscans. So, that's got to be a good place if the hometown people say it's good. Check them out, paliosf.com. Let's see, third trivia question is, which state is located directly west of Louisiana? That's our trivia question. Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Don't touch that dial. The Best of Investing. We'll be right back. Welcome back to the Best of Investing. Edward Brown along with Bill Bymel here. Which state is located directly west of Louisiana? Bill? What's the answer?
Texas.
Texas. No, okay, now you got 1 for 3. That doesn't sound good. But if you were in baseball, that would get you in the Hall of Fame.
That's
all right. Yeah, see, that's all you needed to do. Okay, let's see here. So what will your fund do to capitalize on the opportunities ahead? Because you have a fund that buys discounted mortgages?
That's correct. That's correct. And we started our first fund about 2 years ago, friends and family, personal money of mine. We joint ventured with some Wall Street institutional partners who really trust us and believe in who we are. And that was when we were predicting, we've been working in the distressed loan market for 15 years. And it's been tough to buy distressed product in the last 5 years because it doesn't look like there's a ton of distress in real estate, but there's always a distressed seller. So we really focused our first 2 years on distressed sellers. And when I say distressed sellers, we buy from funds that are 7 years old and they've got some issue with this document. They can't wait any longer. They want to sell, the note or the real estate and just not deal with it. So, but what's really happening now is there's such dislocation in secondary markets. There's there's opportunity to buy performing loans cheaper than you can even buy non-performing. And then there's obviously going to be a continued, there's going to be an uptick in defaults. I mean, it's just a natural occurrence that when we go into a recession, we'll see an uptick in defaults for one reason or another. And it's going to look, again, going back to where the media is going to, the headlines are going to look, you're going to see doubling of default rates in 1 year. But, that's because we're at the lowest default rates in the history.
Yeah, exactly. Now, the thing is, do you think the government's going to put one of those moratoriums on?
I don't, the last time during CARES, you had a medical emergency, you had a scientific, emergencies, you had a real reason to keep people in their homes. And even then, I feel like certain states took it too far, and people are definitely taking advantage of it. It felt a little bit too overhanded on the part of the government.
Well, I'll tell you a quick little story here. So I know of a place where most of the people who lived there were retired, living off pensions. So their income was not affected by layoffs or working at a restaurant and getting fired because of COVID, right? But all they did, but boy, a few of them just ran to the manager and just said, "COVID, I don't have to pay COVID." It's like, wait a minute, your income was not affected at all. You still got your Social Security, you still got your pension check. You can't just yell COVID, right? So let me ask you though, when you take over a loan that becomes non-performing, is already non-performing, do you try to modify the loan and keep the borrower in the house?
That's 100%. I wrote a book about this 5 years ago called Win-Win Revolution, and we really looked to have we have had a huge influence on the non-performing loan investor market in terms of how to approach the distressed loans when you're buying pools. The first 30 to 40% of every NPL portfolio that we buy ends up performing again. And that's because we work hand and foot. The first 90 to 100 days, we take ownership of a loan. We work with borrowers. If there's any opportunity to keep them in their home, or in the case of investment property, to get it to a point where it makes sense for the borrower to start paying again.
Okay, one thing would be potentially lower their principal. You bought it at, if it's a $100,000 loan, you bought it at $60,000. You could all agree it's a now $80,000 loan. It's good for the borrower, good for you. Potentially change the interest rate. Potentially just maybe not even so much the interest rate. It's mostly probably going to be the mortgage payment that's going to be the driving factor, whether or not these people are, if they were paying $600 a month, you tell them from now on only pay $500 a month.
Right.
But you still have to make it in such a point where it still makes financial sense to you. So
it has to not only make financial sense to us, but it also, the borrower has to be able to commit to that long term. We don't want to set them into one of two things that we saw happen the last downturn. In many cases, borrowers got put into these low interest modifications that were with a huge deferred balance or something like that. And it was basically like putting people into a rental payment with the hope that the mortgage market would come back and they would somehow become whole again. Believe it or not, after 15 years of a research or 10 years of market of those real estate values going up, some of those people are still underwater. And in some cases it worked and people got around long enough to sell the properties or break even and whatnot. That doesn't really work. So what we'll do is we'll look more like, can we take this person from 30-year mortgage to 40-year mortgage? That's a very common practice now. Like you said, lowering the interest rate. I believe that this interest rate move may continue upward, believe it or not, for another quarter or two, but it's gonna come back down as quick as the Fed can possibly do it.
You can't destroy the economy. We all lived through the early 1980s. So in your fund, what kind of target rate of return are you trying to achieve?
Historically, our funds have returned about a 15% unlevered yield. So our investors usually
Is that all? No, I'm just kidding. No, that's great.
It's pretty good. It's
Yeah.
pretty good, you know. And when I created this newest fund that we're now opening up to the general public, it's a 506c
Yeah.
accredited investors, of course,
Yeah.
only accredited investors. It is the first. I'm a guy that's come back from Wall Street and wants to bring an esoteric, nuanced strategy back to the smaller investor, back to my friends and family who normally would not have access to this other than through buying shares in some kind of, Goldman Sachs NPL opportunity bond, but you're not really sure what you're buying anyway.
Yeah. Yeah.
So,
but let me interrupt for a second because I wanted to go back to you. We're trying to modify loans for your borrowers. I don't see the twirling mustache. On you where you put. I don't think I've heard that you ever put anybody on a railroad track.
No.
But the interesting thing on that too is that it seemed like in the old days there were predatory people. Just basically, we're doing this just so we can steal your house.
Right.
And so it's really kind of nice. It's a little bit of an impact investing type of thing where you can say, hey, we're actually trying to do good by the borrower if you can.
Absolutely. We have, it's really been my, I did not get into I was a real estate guy. I did not get into the debt buying business to become a debt collector. It's just not what we, I had a good understanding of real estate. I too personally was impacted by all of the horrible servicing that was going on at the last downturn, where borrowers couldn't even get, their banks to tell them anything, or the servicers were telling borrowers they had to stop making payments in order to talk to them. I saw all of that firsthand, and so a lot of that really reflects on my attitude when we come into this: is how can we make a lot of money for investors and do good for society.
All right. Stay with us, Bill. We're going to be back. The Best of Investing will be back with some closing comments. Don't touch that dial, audience. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Bill Bymel. Hey, Bill, what advice can you give independent investors about cash flow and all that?
Yeah, no, I'll speak to real estate, of course, and I'm not an investment advisor. I have to, but in the, really cash flow is king right now. An asset in the real estate world that is able to pay for itself will certainly weather any downturn in real estate values. But the other side of that is that there is some real estate out there that some of you might own that has really benefited from, the way markets have gone the last 10 years. And you might own those properties free and clear. So you can think about, is there some way to take some money off the table if you're looking to get more liquid, whether it's to either have cash on hand for retirement or something like that, or maybe if you're looking to get more liquid to play what's about to happen in terms of opportunity. Now would be a time, before stuff really hits the fan, that to take some money off the table because what will happen is the higher interest rates will cause a devaluation in certain real estate sectors, certain asset classes in certain areas of the country, and it'll take a while to make that up again. So even as rates do come down. So, if you use an opportunity to take some of that cash off the table, get some powder ready. That's my second piece of advice. And my first piece of advice, as I mentioned, is stay in anything that's cash flowing.
All right. Bill, if anybody's interested in learning more about your fund, how do they get a hold of you?
My personal website is billbymel.com, BILLBYMEL.com, and my company is firstliencapital.com, First Lien Capital, LIEN, of course.
All right. And I want to thank you very much for joining us. I want to give a quick mention here also for, Pacific Private Money is still providing mortgage investments, not 15%, but 7, 8, or 9%, very conservative with liquidity. By the way, I forgot to ask you, how long, if someone wanted to get into your fund, what is the liquidity feature?
Right.
How long is that term?
We ask a minimum of a 2-year lockup.
Okay,
After that, we've got a 90-day redemption period.
Oh, all right.
But in order for an investor to take full advantage of that mid-teens return, you're looking at the life of the fund being 3 to 5 years.
Well, for that kind of rate of return, that's not unreasonable. Yeah, and we've had a lot of people invest in the Pacific Private Money Fund, their Freedom Fund. Actually, Pacific Private Money is the company. Their Freedom Fund, there's really no lockup. You just need to give a 30-day notice. It pays 7% for $250,000. For $500,000, it pays 8%. For $1 million or more, it pays 9%. We've actually had people put in mid 7 figures in that. For this very reason, there's a lot of demand still for their loans, and they have outlets for selling the loans. So that's why there's a lot of liquidity, a lot of money coming back every few weeks.
And I love your company's program there. The fact that it is so liquid that people can come and go as they please, I think makes it really one of the more unique lending investment platforms.
Yeah, you are 100% correct. And for that, more information on that, go to pacificprivatemoney.com. Check out the website. In fact, they're one of the largest in the country for doing the owner-occupied consumer bridge loans, and we're probably going to do close to $1 billion this year in origination. So rather than buying discounted loans, they're actually originating the notes.
I love you guys. You guys are the bailout capital for my NPL. There you go.
Yeah, I know. Exactly. In fact, it's interesting because they are going to be, there is a fund, our Southwest fund pays a flat, actually we raised the interest rate to 8%, also with liquidity. And that actually does buy discounted loans, not as big as yours though. All right, you ready for our thoughts for the day? Why are locomotives so good at what they do? They train. And did you hear about the man who evaporated? He will be missed. All right, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.